Big businesses don't save tax by hiding income. They save tax by understanding the rules better than everyone else. And the strategies they use aren't secret. They're structural. There's a common belief that big businesses reduce tax by using loopholes or aggressive schemes. That's not what I have seen. Most large businesses are extremely risk averse when it comes to HMRC. They don't gamble on technical arguments or hope issues go unnoticed. Tax efficiency isn't aggressive, it's deliberate, it's planned, documented, and defensible. I'm Salman Anwar, an ex-HMRC tax inspector. I've worked in the large business directorate within HMRC as well as the Fraud Investigation Service. And I've worked at two of the largest accountancy firms in the land with some of the biggest businesses in this country. And I've worked with the little guy too. I now work with business owners, entrepreneurs, and landlords to make sure that they pay the right amount of tax and no more. Now let's look at the core strategies used by big businesses. One of the biggest advantages large businesses have is control over timing. They plan when income arises and when costs are incurred. They don't wait until the year ends to see what happens. They plan transactions knowing the tax consequences before anything is committed. That's not avoidance, that's competence. They have in-house tax specialists and a team of tax advisors to help them understand the consequences of any transactions they enter into. Large businesses use group structures intentionally. Different entities do different things: trading, holding assets, employing staff, managing risk. This allows profits, losses, reliefs to arrive where they're meant to, not by accident. It's ring-fencing risk, it's ring-fencing profit, and it's ring-fencing the future credibility of their business. Structures create flexibility. Flexibility creates efficiency. Big businesses are very clear about what's capital and what's revenue. That determines how quickly costs are relieved, how assets can be treated, and what tax is paid when. Which reliefs are available for capital expenditure often is taken into consideration at a very early stage when it comes to commercial planning, not just tax planning. They don't guess, they analyze, and often before spending a single penny. Large businesses claim reliefs that exist for a reason. They don't stretch definitions, but they do look at grey areas and take advice. When a relief is claimed, it's supported by documentation and clear commercial rationale. Most anti-avoidance provisions that HMRC applies look at commercial rationale. This isn't about clever tricks. It's about design and intentional use of resource and expertise. Here's the part that really separates big businesses from everyone else. It's not better loopholes. It's access to expertise early. Large businesses don't make decisions in isolation. They have finance teams, tax specialists, and advisors involved before transactions happen. Tax isn't an afterthought. It's a strategic part of decision-making processes and structural efficiencies built into the business. They don't ask how we fix the tax position later. They ask, what's the tax impact before we do this? Another major advantage big businesses have is visibility. They know their numbers inside out and in real time, not 6 months after the year end. Monthly management accounts, forecast, and cash flow visibility helps at every step of the decision-making process. That allows them to make informed decisions and avoid nasty surprises. When you know where you stand financially, tax planning becomes proactive instead of reactive. Most small businesses don't struggle with tax because the rules are unfair. They struggle because decisions are reactive. Transactions happen first, tax is considered later, often under pressure, close to filing deadlines, without any help from specialist advisors. Records are pulled together at the last minute. Advice is sought too late. Most tax problems are not technical, they're behavioral. If you want to be like a big business and you want to get there at some time in the future, you need to look at how they got there and implement that early. That help is available without breaking the bank. The good news is you don't need to be a multinational to think like one. You can replicate big business behavior through outsourced finance support. That might be a fractional finance director, an outsourced finance function, or regular advisory input from your accountant. You don't need full-time staff. You need the right input at the right time. A good bookkeeper is one of the highest return investment a small business can make. Not just someone who records transactions, but someone who keeps things up to date on a monthly basis and flags issues early. Clean records create options. Messy records remove them. Big businesses don't use accountants just to submit returns. They use them to think through decisions. If you're only speaking to your accountant once a year, you're missing the point. The biggest tax savings happen before the numbers exist. Definitely before they're submitted to HMRC. Once the numbers are on the return, most opportunities are already gone. So if you're asking your accountant, how do I save tax on the 30th of January, a day before your filing deadline, that's too late. Remember, HMRC doesn't penalize planning. They penalize poor execution. Structure first, report second. If tax is only something you think about at filing time, you're already playing catch-up. I'm Salman Anwar. Thank you for watching. I'll see you on the next one.